So I'm just going to ask you one quick question, and then I know you'd like to do some comments. What's your favorite job out of that whole journey?
You know, it's a toss-up. I love public service. So working at the Federal Reserve is unbelievably rewarding. We're taking on, I believe, really important economic issues on behalf of the country and the American people. I find that very rewarding. My time during the financial crisis at Treasury was also very rewarding in a very different way. I mean, it was public service, absolutely, but it felt like we were at war every second of every day trying to keep the U.S. economy together. I never want to go through anything like that again, but it was also a deeply fulfilling experience to be part of it.
And just one more question, and then we can go to you. So, what's monetary policy? How is it different from fiscal policy, and why does that matter?
Sure. Well, that's a good lead up into to why I'm here. So let's just start with the difference between monetary policy and fiscal policy. Fiscal policy is the government taxes you and me. How much do they tax us? How do they tax us? And what do they decide to spend that on? Education, healthcare, infrastructure, defense, etc. That's fiscal policy, and your elected representatives make those decisions on your behalf. You may or may not like it, but you vote for them, and then they make those decisions on your behalf. Monetary policy is just trying to manage some of the ups and downs of the economic cycle by effectively putting dollars into the economy or taking dollars out of the economy. So if the U.S. economy looks like it's slowing down too much, traditionally, the Federal Reserve will cut interest rates, make dollars more widely available, which will make it easier and cheaper for you to get a loan. That'll stimulate economic activity. Or the opposite, if it looks like the economy's overheating, the Federal Reserve will typically raise interest rates to try to cool things off. So monetary policy is simply trying to manage some of the ups and downs of the economic cycle. Fiscal policy is much more fundamental. How much do they tax us, and what do they spend that money on? And that's a very political decision, the tax and spend decision. Monetary policy is meant to be a non-political decision. Let's just look at economic data and make these short-term adjustments based on the data, not based on politics.
Would you like to explain a little bit more about the Fed? And
sure.
For the audience?
Yeah, thank you again for having me. The Federal Reserve is, why am I here? I always like to tell audiences, why am I here meeting with you? I'm here because there's something unique about our central bank. So the Federal Reserve is our nation's central bank. 105 years ago, 106 years ago, when Congress created it, they wanted it not to be concentrated in Washington, D.C. So they decided to distribute it all around the country. So they created what's called the Board of Governors in Washington, D.C. You mentioned Alan Greenspan, and after Alan Greenspan was chairman was Ben Bernanke, then Janet Yellen. Now Jerome Powell is chairman of the Board of Governors in Washington. And then they created 12 independent Federal Reserve banks, including the Federal Reserve Bank of Minneapolis. And the reason Congress created it is they wanted us to directly represent this region in the nation's monetary policy process. So a big part of my job is traveling around our region and meeting with folks, meeting with workers and business leaders, civic leaders, to hear directly from you what's happening on the ground in your community, in your economy, so I can take that back to Washington, D.C. when we set monetary policy for the nation. So that's why these meetings are really important to me, and I jumped at the chance when Kathleen sent the invitation, because I really want to hear directly from you. What's happening in your local economy? What's happening to wages? What's happening to your businesses? The more direct, and I thank you for saying don't be Minnesota nice, the more direct you are with me, the more I'm going to learn. So don't pull any punches, hit me right between the eyes, metaphorically.
Okay, let me ask one question, maybe to get the audience going. You've been widely praised and criticized for some of your votes in the past when you were on the correct committee and commentary on raising interest rates. Can you give us a little understanding of your philosophy on that and how you've positioned yourself?
Sure. So diving into monetary policy, Congress has given the Federal Reserve what we call a dual mandate. So two goals. One goal is stable prices. Think of an economy that's not overheating, but also not crawling. The other goal is maximum employment. As many people who want to work are able to find jobs. Traditionally, we think these two goals are linked through wages. So as the job market gets tighter, the economy heats up, the job market gets tighter, businesses have to compete for workers, they have to pay more, then they end up passing those price increases onto their customers, and then that leads to inflation. So that's how we think the job market and the economy are linked through wages, traditionally. Well, for the last few years, actually for the last 5 or 6 years, we've been coming up low in our inflation target. We try to achieve 2% per year. And we've been surprised how many Americans have been coming off the sidelines trying to find work. So historically, the headline unemployment rate, it gets a lot of attention in the press. Right now it's 3.9%. Historically, 3.9% would be screaming, we're there. We're at full employment. Everybody who wants to find a job is able to find a job. You can't run the economy any hotter. Well, what's happened over the past couple of years? All these people have come off the sidelines and said, I want to work. You know that headline number, 3.9%? It only includes people who are actively looking for work. If you gave up because the financial crisis was so severe, you're not counted in that number. So it turns out there are a lot of people who are not being counted who actually wanted to work. And wage growth has ticked up a little bit. It hasn't really taken off yet. And so I've been objecting largely to our interest rate increases because I've simply said, we don't know how many more workers are out there who are not being counted today. If inflation is low, there's no need to tap the brakes prematurely. Let's let the economy continue to strengthen. Let's bring more workers off the sidelines. And if wages really pick up, and if inflation starts to pick up, we can always raise rates then. There's no need to snuff the economy before it really heats up.
Is there any correlation, or does the Fed sit and how do they think about the recent stock market volatility? Does that impact monetary policy decision-making or calculations?
We pay attention to various financial markets because for a couple reasons. One reason is financial markets are trying to make their own assessments of the economy and the economic future, just like we are. And they're trying to, in theory, the stock market incorporates all the information that's readily available into a price. And so maybe the markets are reaching a different judgment than we're reaching. And if they are, we should at least know why we're making a different judgment. That's number one. And number two, we also do know that there's a wealth effect. If people feel wealthier, they tend to spend more money, they buy more cars, maybe they buy a new house, and there can be a feedback loop or a self-fulfilling prophecy. So we don't target the stock market directly. I don't think our jobs are to protect investors from losses. Markets go up, markets go down. Sometimes investors make money, sometimes they lose money. That's life in a capitalistic society. That's capitalism. But if there's information contained in the markets, we want to at least acknowledge that information and make sense of it.
Can we go to some audience questions? Ooh, we have one in the back.
And a mic is going to come to you.
And the mic's coming to you. And we have 2 microphones, and we're going to try not to have any lag. So how many else are going to want to ask a question so we know where to position this mic?
You mentioned some of the indicators that the Fed watches, like inflation and labor. A lot of these economic indicators are really, really old. Inflation doesn't include some key cost inputs. Labor only reflects those looking for jobs. What's your take on updating some of these economic indicators to really be a little bit more meaningful?
Well, we look at a lot of different indicators on both inflation and on the labor market. It's not just one. And I would say those indicators are constantly being updated to incorporate new products that we may buy as consumers. And they're always looking and back testing when they have to make adjustments. What can the economists learn from to make their assessments more accurate going forward? I would say that the indicators are not perfect by any stretch. I mean, one of the famous examples that's hard to account for, how do you account for the fact that your iPhone is getting way more powerful? How do you factor that into the cost of what you're buying? Are you buying the same thing that you bought 10 years ago, or are you paying more but also getting more? So it's imperfect, I give you that. But I think really smart economists are constantly looking at this data, looking at the analysis, and trying to update it to get better and better and better. On the inflation front, we look at a lot of different measurements put out by the government. We look at private sector estimates. We have our own internal models, all trying to get a sense of what's really happening, what are consumers really experiencing. So I don't think it's perfect, but I think it's pretty good, and I think that it's constantly getting better because people are working hard at it.
Elaine Case has a question, one of our community leaders.
Thank you. Can you hear me? Okay.
Yes.
So I don't think most business leaders wake up every morning and say, gee, the thing I should worry about most is early childhood education. But if you look at the research, that would say that you should look at that. And I recently got the opportunity to hear Art Rolnick, one of your predecessors, speak about the importance and criticality of early childhood education as related to business and economics. Do you have any thoughts about that?
Sure. We know that education is a huge driver of different labor market outcomes. So people who have higher education generally have less unemployment. They also have higher wages. And as our economy is becoming more knowledge-driven and technology-driven, education is only becoming more and more and more important. And the research that Art, one of our former colleagues at the Minneapolis Fed, and some of my other colleagues, Rob Grunwald and others, have worked on, has shown that starting earlier in life has huge payoffs in terms of the outcomes for that individual, but also for society as a whole. And so I think, Art was famously challenged when the Minneapolis Fed has taken a stand saying government spending money on sports stadiums as cities compete against each other is not a great use of taxpayer resources. So the story goes, I'm told, that somebody said, okay, Art, Mr. Smart Guy, what would you invest in? And he said, okay, let me go look. And he went and did a bunch of research, and he said, actually, a taxpayer dollar invested in early childhood education has the best return for taxpayers than any other investment that we could find. Certainly better than competing against other cities to build sports stadiums. And so that's what ultimately led to that research, but I think it's very, very compelling.
Thank you very much, and thank you, Elaine, and all the people who work on Cradle to Career in this community to really look at the spectrum of preparation of all of our workers. I think we have a question from Christian. If you could just say your name, Christian, and your sector, that would be great.
Sure. My name is it on? Oh, yes, It is. Okay, great. Christian, I work in the transportation sector, our family business here in the Rochester area. Before I ask my question, I just want to say thank you for being here, and thank you to the Chamber for putting on this event. It's fantastic to have someone with such a broad spectrum overview of like yourself here this morning. My question is, we've seen signs of an increase in the labor force participation rate, and I'm just curious if that, from your perspective, does that have any delaying or impact on the rate of automation or innovation in the economy as more workers are coming back in? Are we going to see that have any short-term or long-term effects on those areas? And I'm particularly interested in how that applies to maybe the transportation sector, where there's so much potential through automated vehicles.
I think that they are related. So as the gentleman mentioned, we've seen a lot of people coming in off the sidelines. So there's a measure of labor force participation, the percentage of Americans of working age who are in the job market, either have a job or are looking for a job, as opposed to those who've just said, I'm out of the job market. Somebody's retired, they're out of the job market. They're not counted in labor force participation. So we've been pleasantly surprised as people have been coming back in. We don't know, as I said earlier, how many more there are. And that affects businesses, in theory, that affects businesses' decisions to automate. So you would imagine if wage growth was really taking off because they really couldn't find workers, businesses might say, you know what, I'm going to invest in this machine because this machine will give me a better return on my investment than having to pay higher and higher and higher and higher wages. Well, if there's a lot more labor supply out there, and that's keeping wage growth more limited, then you would imagine the trade-off between investing in new equipment and just hiring another worker, they might favor the worker if the workers are available at slightly lower wages. So I do think that they are related. As for automation and the future of work, and I know you weren't saying this, but a lot of times people will ask me about, oh my gosh, artificial intelligence and robots, and a lot of Silicon Valley luminaries predict the end of labor. Right? People have been predicting the end of labor for all of recorded history. Right? When automation first came to farms, they said, oh my gosh, all of these Americans are going to be out of work. There's nothing left for them to do because of tractors and different implements on the farm. Well, they moved into factories. The nature of work changed. So I don't believe for a second that we are facing the end of labor. I tend to think Silicon Valley hypes things up about 100x more than they're really warranted, and things take a lot longer. So I think nature of work will change. If self-driving cars and trucks materialize the way people think they will, maybe we'll all be driving around in self-driving Ubers in the future. We'll see. But I suspect there's still going to be a lot for us to do.
Question over here.
Hi, I'm Patrick C. with Destination Medical Center, and I guess my question sort of picks up on what you were just talking about, what you just what Kristen just asked about in terms of automation. So so we did a survey before you came here. Ron led a survey. Many of the questions were very near-term questions, sort of looking the next year, next quarter. How does the Fed look at big seismic changes, such as automation or automated vehicles, and think about and sort of help us think about what those changes mean to the economy and forces that will shape the economy?
Well, we have the Federal Reserve System nationally, I think, employs more PhD economists than any organization in the world. So we have researchers in Minneapolis and all around the country doing research not just on short-term issues, but also on long-term issues, such as productivity growth and automation and the future of the U.S. economy. These are really important factors for us to understand, even if we're trying to understand what the economy is going to do in the next 12 months or the next 2 years. Having the context for what do we think the trends are in the U.S. economy over the long term is really important in making that near-term assessment. So we care a lot, we pay attention a lot to it, and we try to educate the public as we learn new things, but there's a lot of this that's unknown, at least at this point, that we're not sure about. So for example, we always talk about technology. Technology is innovating, it's changing our lives, et cetera. But if you look at the aggregate productivity statistics, the U.S. economy in the last 10 years has not been having a big uptick in productivity. Now, you would think Twitter, Facebook, et cetera, Instagram, that must be leading to a lot of productivity. I guess I would push back and I question whether social media, in fact, leads to productivity enhancements. But so we care a lot about these issues because they ultimately drive long-term economic growth, even if they may or may not be that important to the short-term economic cycle.
Another question over here.
Good morning. My name is Greg Moore, and I'll take this opportunity to hit you between the eyes. So last week I saw an interview with Jerome Powell on Fox Business, which I thought was a great interview, where he talked about maybe exercising some patience as you look at rates. You had mentioned about possibly not snuffing out the economy and the rate increase. I'm a small business owner, and we have a loan out, so I'm very sensitive to your thoughts, and specifically, what do you need and what does the Fed need to see to maybe relax those rates, and what do you see as maybe the next 2 to 4 years in that area?
Well, as Kathleen said, we rotate among the Reserve Bank presidents on when we are formally voting on the interest rate increases. So I voted in 2017. There were 3 increases in 2017. I voted against all 3 of those increases because I didn't see evidence in the data that the U.S. economy was overheating and that wage growth was really taking off. I haven't seen much evidence since then either. I mean, the job market continues to strengthen, but wage growth has been muted. So for me, I'm paying attention to, are there more workers on the sidelines that keep coming in? What's going to happen to wages? And even if wage growth finally picks up, that doesn't necessarily mean it's going to lead to higher inflation. So we need to pay attention to all of these different measurements. Every 3 months, the Federal Reserve, all of my colleagues and I, put out what's called a summary of economic projections. We all put out our forecast for what we think the U.S. economy is going to do over the next couple of years. That summary of economic projections implies 2 rate increases in 2019. Now, will we actually raise interest rates twice? I don't know. It's going to depend on what the data actually comes out. Could it be more? Could it be less? We'll have to see. But I'm paying attention to labor market data, wage data, inflation data, and right now I'm not seeing evidence of pressures that would warrant raising interest rates further.
Any other question? Another question over here.
Bruce Schwartow, and I'm in higher education. Just wanted to get your thoughts on when we take a look at the United States economy and with the Federal Reserve, and we compare ourselves, let's say, to other economies in the world where we don't have those type of operations. How would you say we're doing as compared to other world economies right now and the advantages we have with the Federal Reserve?
Well, I would say all advanced economies that I'm aware of have a central bank. There's the Bank of England, goes back centuries. There's the European Central Bank, the Bank of Japan, the Bank of Canada. Those are all their versions of the Federal Reserve. And the consensus that's been developed over the last 30 or 40 years is that if those institutions are kept isolated from politics, they can make decisions based on data and analysis, not based on short-term political considerations. And I think all advanced economies have benefited from that realization that keeping politics out of monetary policy has served us all well. The countries that don't have it independent, and these are not advanced economies, you'll see small economies that the political independence has been compromised, and ultimately you can see very high inflation. If people lose confidence that the central bank is going to make decisions for economic reasons rather than political reasons, investors get nervous. And then they say, hey, wait a second, you may just inflate away the economy. I want to be compensated with higher interest rates. And that can lead to a vicious spiral. I read a lot of American history, and I've been reading a lot about the U.S. Civil War. The Confederacy had their own currency. And they thought, well, you know what, we're just going to fund the war by printing this Confederate money. Well, guess what? The Confederate money ended up not being worth very much. And so soldiers were getting paid, and they're like, well, I can't even buy anything with this because the money's no good. And so ultimately, people have to have confidence that the currency is going to be managed appropriately, not for politics, but for economic reasons.
Thank you. Question in the back?
Scott Heck, RBC Wealth Management. I didn't introduce myself last time. With the change in the tax law recently, it created a much more favorable environment for repatriation of assets. Does the Fed watch that, and has that happened at the rate that you would have expected with the change in the law?
We do pay attention, and we do pay attention in part because we want to know how much the government taxes, how much the government spends, is there a economic stimulus. That can affect the economy in the short run, in the medium run, and the long run for that matter. And then how much businesses are investing. That also can affect both inflation in the near term, and maybe it can affect the supply side. Maybe it could lead to higher productivity growth in the future if businesses make a lot of investments. My sense is I have not seen evidence that there's been this huge repatriation windfall, that all this money has come back to the U.S. and gone into new capital investments. I think there's been some uptick of investment, but I haven't seen evidence that there's been any kind of an investment boom in the real economy. You read the press reports, there's been a lot of reports of stock buybacks, and I'm assuming in your line of work you see that as well. But that to me is a little bit different than a company saying, I'm going to go build a new factory or invest in new machines, et cetera. So I, for one, haven't seen some big uptick of cash coming back and going into more investment. I would like to see that, because that would imply to me that maybe we'll have higher productivity in the future if businesses are making more investment today.
Commissioner Cascaden?
Good afternoon, Sheila Cascaden. I had the pleasure last year of serving on the task force on affordable housing for the state of Minnesota. And as we look at our workforce issues and know that housing is directly related to workforce, we have a workforce shortage. In my view, we have a competitive advantage as a state because our housing is more affordable, yet we know we are short 300,000 units, 50,000 units a year. And putting that puzzle together, how do we get private sector investment from employers' perspective into housing as well, so it has a direct impact on our whole region and in all communities. And I'm just wondering what the Reserve has done on the housing questions that are facing our state and others across the nation.
Thanks for raising the question. Everywhere I travel, this is quite remarkable, everywhere I travel in our region, and by the way, the Minneapolis Fed represents Minnesota, North and South Dakota, Montana, the Upper Peninsula of Michigan, and northwestern Wisconsin. Everywhere I go, every community has an affordable housing issue. So it's widespread. Red county or blue county, it's widespread, it's across party lines. And so our economists at our bank are doing a lot of work on this issue, trying to understand what's going on. How can this be such a widespread issue? And importantly, if people have jobs, just like you said, so a lot of businesses say there's a worker shortage. So people have jobs, and yet they cannot afford a place to live. So why isn't the private market, why aren't developers going in there and saying, hey, I can make money building a home or an apartment or a condo or a townhouse for this family? What's broken? Why isn't that happening? Because I'll tell you, I've never seen, everybody needs a place to live. I've never seen an appropriation that is going to satisfy this problem. There's not enough money in the state budget. Let's just be blunt. There's not enough money in the state budget to solve all of our affordable housing needs. So somehow we've got to get the private sector mobilized so the developers say, hey, I can make money building this apartment building or this home. That's the only way you get scale. So what we found so far as we're looking at this is there are a lot of barriers that are self-imposed to new supply coming in. Whether it's regulations on minimum sizes or minimum lot sizes or different amenities, each of which may be well-intentioned. But when you put them all together, what do? You drive up the minimum cost of a unit or of a house, and you directly hurt the working poor. I'll give you the most egregious example of this, and it's not Minnesota. California, the state of California recently passed a law mandating solar panels on every new home. All right, if you add $10,000 to the price of a home, you have made that home less affordable. I don't care what your ideology is. I don't care what your views of the environment are. I'm doing math, and that's the math. And so I think we need to have a hard look in the mirror and ask ourselves, how do our good intentions translate into the math of affordability for working families? And I think we need to confront that as a state.
Thank you very much. I think we have a question over here.
I'm Tom. I'm an accountant, and I know that in the Federal Reserve you're not in charge of fiscal policy, but when you sit back and discuss the fact that we have a $20 trillion debt, that Social Security and Medicare are just going to have a lot of pressure put on them by the baby boomers and everything, do you guys say that's a disaster waiting to happen? Do you say monetary policy can help keep it level? How do you think it affects the long-term health of the U.S.?
Well, monetary policy certainly cannot solve that problem. I mean, that is purely a problem for politicians to decide how much to tax and how much to spend. And ultimately, we know no society can continue running ever larger deficits year after year after year perpetually. It just doesn't work. But I will say at the same time, investors around the world get to decide every day where they want to invest. And investors around the world, with all of our political challenges in our country and all of our promises that we've made to ourselves in the future, investors around the world are still saying they have more confidence in the U.S. economy and the future of the U.S. economy than they have in any other economy in the world. Now, you may argue that their confidence is misplaced, but ultimately I think investors are saying at the end of the day, the United States political system will find a way of addressing these promises versus the resources that we have and find some type of a sustainable situation. But if you just forecast like what's in law today, the debt just goes through the roof 20 or 30 years from now. Obviously that can't happen. The question is, how do we reach political consensus to reach some kind of a sustainable trajectory? And I don't have an answer to that, but I'm just saying investors around the world have confidence in the U.S. So now we have a runway to make some decisions, and we should make those decisions while investors still have confidence in the U.S.
I'm going to exert a prerogative here. I've just found I really enjoy reading your editorials, your personal writings, and I'm really impressed with how much you write about the social and economic disparities we face. And I'd like to talk a little bit about that. We're a growing community. We're experiencing some of the pains of growth, and some of that comes to disparities, and I'd love to hear from you about that.
Sure. One of my biggest surprises moving to Minnesota, so I've been here 3 years now, we've got a lot going for us. We have a very diverse economy. Most major sectors of the U.S. economy are represented in Minnesota. Overall, we have a very educated workforce. On average, we have good schools, a vibrant business community, et cetera. A lot of strengths. But I was surprised that we have some of the largest disparities in the entire nation. Racial disparities, they're also geographic disparities, and they've been with us for a long, long time. So I started asking our economists, why do these disparities exist? Why are they so persistent? What can we do about it? And I'll be honest with you, I found very few satisfying answers. So a couple of years ago, we launched a major new research center at the Minneapolis Fed that we call the Opportunity and Inclusive Growth Institute, where we bring the best researchers from around the country to Minnesota to work with us in-house to unravel why are these disparities so persistent and what can we do about it. We talked about education earlier. We know education is at the root cause of this, right? If you live in a well-to-do neighborhood, there's a very good chance your kids are going to get a good education. If you live in a poor neighborhood, there's a very good chance your kids are not going to get a good education. That is a fundamental problem in our society that leads to disparities that get passed from generation to generation to generation. So we know education is part of it. We know housing is part of it. We know transportation is part of it. These issues tend to be wrapped together. They're multifaceted, but we have to make progress because right now we're not making progress. I mean, Minnesota has been working on education disparities for a long time. And if you look at the data, I'm going to be blunt. We've made no progress. Zero. If you look at the test scores of average whites versus average African Americans or average Native Americans, zero progress in the last 20 years. And that's a problem.
The question over here.
Hi, I'm Jocelyn Raymundo. I am a small business owner. I believe way back in 2008, I think Greenspan had a speech about challenges for healthcare reform. Can you give us some of your thoughts about healthcare and its huge share of our GDP, the growing trend, and what it really means to the overall health of our U.S. economy? Because it's in everyone's mind as a small business owner, as we provide benefits to patients, to our employees. That is something that is really facing us front and center.
Yeah, no, I think it's a huge challenge facing our whole society. And the challenge is we all, every one of us, myself included, for my family, we all want the very best health care. And the very best health care is very expensive, and it keeps going up. And as new technologies get developed, those end up, in many cases, costing more, and yet we demand it. And so somehow there's been a major fundamental breakdown in saying, just because I want, and maybe I feel like I deserve everything, ultimately the money has to come from somewhere. And so to me, this fundamentally is a political question of making choices. We have finite resources as a society. How do we distribute those resources? How do we allocate those resources? How do we do it in a way that we think is fair and giving people what they feel like they want and they deserve? So far, I haven't seen a lot of our elected leaders stepping forward and saying, you know what, everyone's not going to get everything they want. And to me, that's the root of the problem. We have to look at ourselves, have an honest conversation. We're not all going to get everything we want. There's only so much. How do we now allocate in a way that meets the needs of society? And that's the fundamental, to me, that's a political challenge that our elected leaders need to take on. And I have not seen us have that conversation yet.
Just a follow-up on that, if I could, Jocelyn. Is there, in your mind, an appropriate percentage of the GDP that should be health care? It's become this sort of political boogeyman that, oh my gosh, 17% of the economy is health care. Is that something we should be concerned about?
I don't know. I don't know the right answer to that. I mean, in an ideal world, wouldn't it be great if 0% of our economy was spent on defense? In an ideal world, if we all just lived in a very safe planet, we wouldn't have to spend any money on defense. Obviously, that's not realistic. I'm not actually advocating that. So I don't know what the right share is in light of the other needs that we have as a society, whether it's education or it's defense or it's infrastructure. I mean, that to me, we as a population, we have to make that decision together.
Over here.
My name's Dan Beck. I'm with Think Mutual Bank. And Neel, since we're on a first name basis, you can just call me Dan.
Okay.
About a year ago, I think you wrote an article or an op-ed for the Wall Street Journal on immigration and talking about how immigration really is free economic growth for us. Can you tell us, forget the illegal immigration issue, but can you tell us what are the real issues that are getting behind solving this problem that's been out there for years and years and years with the efficiency of immigrating folks to the United States?
Well, this goes back to where does economic growth come from? At the end of the day, long-term economic growth comes from two sources. One source is productivity growth. So new technology makes us more efficient, and better education makes us more skilled in whatever we're doing. So that's productivity growth. The other half of the equation is population growth. More workers to produce things and more consumers to buy things. Well, that half of the equation, we're not having kids at the same rate that we had 20 or 30 years ago. And that's true in advanced economies all around the world. And so unless we do something about that, our economy is not going to grow the way we've been used to it growing. So I always say to audiences, you have three choices. Number one, you can accept slower economic growth. Number two, you can spend a lot of taxpayer money to try to subsidize fertility. People usually laugh when I say that, but you can give tax credits to families to have kids, or free childcare. It's very expensive, and by the way, it takes 20 years to grow a new worker, just to point that out. So it's not a quick solution. Or number 3, you can embrace immigration. That's it. Again, I'm not here to offer you a moral judgment. Those are your 3 choices. I'm just doing the math. And, immigration, we're not perfect as a country in terms of integrating immigrants. We're just better than anybody else in the world. Immigrants from around the world want to come here. And so this has been a huge competitive edge for America for all of our history. And it can continue to be a huge competitive edge if we design an immigration system that meets the needs of our economy. So I think the math is very, very clear. If we want strong economic growth in the future, immigration is going to have to be a big part of it. So my personal view is, let's design an immigration system that feeds our economy. And that means we need high-skilled workers, but it also means we need workers in meatpacking plants or on farms, et cetera, to meet our economic needs.
Another question? Over here.
Hi, my name is Joe Wise. I'm a building contractor, and you've been answering some awfully tough questions, and I've been impressed with your answers. I think it's about time you get one with a little fluff in it.
I was waiting for the but. I thought you were going to say, but I disagree with you on this, but go ahead.
Oh, seriously, would you care to share with us a typical workday in the life of the president of the Minneapolis Federal Reserve is like?
Sure. I appreciate the softball question.
They don't come from Joe Weiss often.
I always think about my job in 3 components. A third of my job, roughly, is getting out across our region, just like I'm doing right now, meeting with folks, hearing from you, answering your questions. About a third of my job is management. We have 1,000 employees at the Minneapolis Fed. There are sorts of management issues that come up in any organization that I spend a lot of my time on. And about a third of my time is spent deep in policy development, where I'm working with our economists, either looking at what's happening in housing in the country or in our region, what's happening in education, or really importantly, digging into the inflation data, the wage data, the labor market data, to understand what's the right course of monetary policy. And that division, being out with the public, I enjoy it. I think I've become pretty good at it. Management issues and then deep policy work, that fits my interests and I think my background very, very well. So every day is a little bit different, but that's roughly how I spend my time. And then I have to go back to Washington every 6 weeks for the Federal Open Market Committee meetings, and then I travel around our region quite a bit too.
When you are meeting with other colleagues, other presidents from the different regions of the country, where do you think, this may be an unfair question, when you look at them, are there conditions that you wish we had? Or what's the competitive landscape out there?
Well, there's always, usually whatever region wins the Super Bowl in the FOMC meeting, somebody's always crowing about having won the Super Bowl. So I think last year Minnesota hosted the Super Bowl, and I commented in the meeting that I said we would much rather have been playing in the Super Bowl than hosting the Super Bowl, which I think was an accurate comment. So on sports teams, there's a lot of competitiveness around the country.
Good duck.
Yeah, good duck. Otherwise, Silicon Valley is a very special place, right? There's only one Silicon Valley in the country where there's this much innovation taking place. So I think all of us look at Silicon Valley and say, what can we learn from the innovation that's taking place there and potentially bring them to our regions? But, we talked about affordable housing. Silicon Valley has affordable housing problems that put ours to shame. So it's not as though it's all positive with no cost associated with it. So I think we try to learn from each other.
Thank you. In the back?
Mike Gargaro in the community banking space. Recently, I know the Fed had asked for comments on faster payments. And at the end of the day, I know it's only been about a month since it's closed, but where do you see the Fed's role in faster payments?
Well, one of the things the Federal Reserve does for the country is we operate the payment systems, many of the payment systems for the country. So wire transfer, there's something called FedWire. We process these for banks to bank. But as you know, if you write a check or you have an ACH transaction, it can take a few days for it to ultimately settle in your account. Some other countries have gone forward and said, you know what, we should have instantaneous or real-time payments. So if I send you money, it comes out of my account immediately, goes into your account immediately. So the Fed right now has a process where they're soliciting comments saying, should we offer a real-time payment system for the U.S. economy so that we don't have these delays of 2 or 3 days? It seems like there's a lot of momentum behind it. It seems like people generally want the Fed to operate this. Some of the banks are saying that they can do it, that there's no need for the Fed. Some of the small banks have said they don't want to be beholden to the big banks. So I think it's an ongoing set of analyses that are being done right now. But it seems like the U.S. economy is going to be moving to more of a real-time payment system in the future. My guess is the Fed will have some type of a role to play, but how big a role, I think that part is still unclear.
Question? Mike?
I'm Tim Deutsch. I got a 4-year-old, a 1-year-old, and a third on the way, so I'm doing my best on the population issue. But I heard you are a child care expert, so you got any advice, having 3 young kids now?
How did you hear that?
That's the rumor going around.
I don't know who told you that, but that was...
But in seriousness, child care, the cost of child care is a real issue, I think. So I don't know if you have any commentary on that at all.
Well, it's something that I'm learning about. It's something I'm learning about, and I'm going to be learning more about soon. So it's a big issue. Everywhere I go, I hear the same thing, and I'm trying to understand why is child care in fact becoming less affordable? I mean, is it becoming more expensive than it was 20 years ago or 30 years ago? And I know it's because family structures have changed. Now you have both parents that are working, so the child care needs are different. And it's also related, it's a very complicated issue that I'm actually spending some time with my economist working on, because it's also related to income inequality. This is just, my thinking on this is only at the beginning. Anecdotally, you'll hear people who say, hey, I got transferred to India, or I got transferred to the Philippines. And what was so great about it is there was so much help available. I had a nanny, I had a driver, I had a gardener, I had a housekeeper. It was so great. Well, sure, if you have abject poverty surrounding you, there's lots of child care available. So I think one of the challenges we have in a society is how do you achieve low income inequality and affordable child care? I actually think those two things are related and in some sense in conflict with each other. So I don't have an answer yet, but this is something that I'm actually looking at and trying to dig into, because I think as we want a society where people are earning more, then your trade-off, you or your spouse deciding, hey, should I stay home? All of a sudden it becomes if you have to pay more, then I may just stay home, right? So these things end up being linked, and this is a very complicated question. I'm sorry I'm giving you a rambling answer, but that's only because my thinking on this is actually evolving right now.
Another question? Okay, let me ask one. Our county, the economic landscape here in this region is incredibly unique, with a phenomenally large, great, generous employer, best health care provided in the world, and predominantly small business. We have 3,800 businesses in Olmsted County alone, under 100. That's a very unique economic landscape. And I read a lot about small business confidence. 45% of small businesses I read last night believe that the economic outlook is good. And I'm sure that data is not as valid and reliable as the Fed's economic research, but it concerned me. And I wanted to ask you, is small business confidence an economic indicator that's relevant?
Absolutely. I mean, at the end of the day, confidence is what leads us all to choose to spend money. If you're nervous about the future, you say, you know what, I'm not going to buy that extra thing, or I'm not going to upgrade my dishwasher or buy a new car, etc. And if everybody gets spooked at the same time, even if there's no actual economic problem, if everybody gets spooked at the same time, that becomes a self-fulfilling prophecy. We all hold back, and then that slows down the economy. So confidence is enormously important, whether it's consumer confidence or small business confidence. It's a very important economic indicator. Now, we don't want to just puff people up and say, hey, everything's great, go out and spend if we're actually nervous. But it is important to pay attention to it because it can become self-fulfilling.
We were hearing from an AGC a while back that they believe the confidence indicators of architects is a bit of the canary in the coal mine. And I just wondered if small business is sort of similar. And their recent survey showed less confidence in the architects than in the other parts of their industry. So would you recommend to small businesses now, I mean, that's an unfair question, that they can consider some financial fortification or strategies to deal with potentially the future?
I mean, I think we always should do that. You know, financial crises like the Great Depression had a profound impact, not just on the people who lived through it, but their kids. And it lasted for decades when you could actually see the psychological scarring of the Great Depression. I think the same thing is true for the great financial crisis that we had in 08. I'll give you an example. Having come through 08, I was okay economically, but I now personally pay down debt as quickly as I possibly can. That's going to be with me forever, having lived through the financial crisis. And by the way, I'm not ashamed of that. Like, I actually think that's pretty prudent to pay down debt when you're able to pay down debt. So I actually think, as a general matter, people being prudent with their resources, whether it's a small business or a family, I think that that's just good. But obviously, if we overdo it, then the economy will grow more slowly.
Question? Oh, this
The
will be
gentleman
an
back there has the mic.
important one.
Pat
I'm going
Sexton,
to. Oh, sorry.
consultant.
We'll come back to you, Harry. Thank you.
Minnesota is often listed as one of the least competitive states in the nation. Why is that, and what can we do about it?
I haven't seen that we were one of the least competitive states. I think it depends on who's doing the accounting, because oftentimes I'll see Minnesota's doing pretty well. My guess is if it's one of the least competitive states, people are making an assessment of state taxes relative to some other places that have very low state income taxes, or in some cases no income taxes. The general feeling that I get when I meet with folks around Minnesota is people feel like we're getting pretty good value for the taxes that we pay. I tend to hear that a lot relative to some of the states that I've lived in. Now, you may disagree with that. I'm just sharing with you what I've anecdotally heard from folks. You know, look at our schools. On average, again, we got huge disparities, but on average, Minnesota schools are ranked somewhere 5th, 6th, 7th in the nation in terms of outcomes. So on average, you know, Minnesota schools are doing pretty well. But I think it's more complicated than that. We have a very vibrant business community. We have a disproportionate number of Fortune 500 companies in Minnesota. We have excellent universities that do attract talent from around the world here to Minnesota. So I'm not sitting here ready to bet against Minnesota. I think we have a lot going for us. I think we can do better. Everybody can do better. But I think Minnesota is actually pretty well positioned competitively.
Harry Hoffman.
Hi. What are your views on developing credit conditions, particularly the high yield loan market, the leveraged loan market? There's been a real sort of slowdown in the secondary loan market where most of these corporate loans are going.
Yeah, so this is something we're paying attention to. So as the stock market got very volatile over the last few months, you've seen portions of the corporate credit market, the riskier segments of the corporate credit market, which dried up considerably. And that's what you would expect as people are getting nervous. If people are getting nervous, you would expect them to pull back from some of their riskier investments, and some of the loan markets that you talked about are an example of that. So I think it's something we're paying attention to. I don't think we're overreacting to it, but I also think we're not ignoring it. Again, we're trying to look at it and say, what is this telling us about business's view of the economic future, and can we learn something from that?
Another question? So you're not going to ask a question of the person who received the most prestigious award from the Department of Treasury, the Hamilton Award. So congratulations on receiving that. That is incredibly impressive.
Thank you.
During your service. So I have to ask you, did you see Hamilton?
I did see Hamilton. We saw it a few years ago, and it was spectacular. I didn't really actually know what to expect. It was early on in the hype cycle of Hamilton, so I'd heard a little bit about it. I heard it was really good, and it was fantastic. So I hope many of you had a chance to see it when it came to the Twin Cities.
Was there an exhibit too at the Federal Reserve about Hamilton?
There was. We actually had, it was really fun. At the Minneapolis Fed, we did a big month or 2 month long Hamilton exhibit. We had special Hamilton tours. And then we had a contest, a social media contest for students in our region to talk about economic policy and what they wanted to do and be creative. And there was a really bright kid, a high school student from the Twin Cities, who did his own little rap video about economic policy and what he wanted to do in economics to the music of Hamilton. It was spectacular. And we gave away 2 Hamilton tickets, actually to him and his sister, for winning the contest. And so it was really fun.
Great, we have a question over here.
Morning.
Morning.
I'm Seth Behrens. I'm an architect with Hamill Green and Abrahamson in Rochester here.
So let me ask you, though, you're an architect. Are you feeling that things are getting nervous, right, as an architect?
Well, we were wondering amongst a number in our group if it's real economic factors happening or if we just tend to be a little more pessimistic as a group. But we'd like to see maybe comparisons of that over the previous 5, 10, 15 years, historical data, how those charts look for architects versus contractors versus subcontractors. But we hope that, in that scenario, the canary dies. So we certainly hope that we're not a harbinger of things to come, at least in the near future. My question was actually to something you had mentioned earlier in the affordable housing answer, when you talked about solar panels on homes in California, and that makes that home $10,000 more expensive, and that's just simply not affordable, and you're doing simple math. But historically, I feel that we have discounted the environmental impacts of economic growth, and I was wondering if you could speak to ideas and the validity of a Green New Deal. Can we transition some of our economic inputs away from maybe pure growth-based and into some of these sectors that might start to counteract climate change and give our society a brighter future decades and centuries down the road?
Well, I certainly applaud the goal that you just articulated, but we also need to be honest with each other. These things aren't free. And to just say, well, somebody should invent some technology that's cleaner and cheaper, sure, that'd be great, but we haven't figured it out yet. And until that happens, there are real trade-offs that we have to make. And so, again, one of the same people, I think, who are arguing for the Green New Deal are also arguing for very low income inequality and better economic opportunity for those at lower income levels. But if the Green New Deal means that it's much harder for low-income families to afford to buy a house, what's the right trade-off? And I'm not here to tell you what the right answer is. I think people need to decide for themselves. I'm here to tell you that there is a trade-off. And to just pretend that there's no trade-off, that everybody can have everything and it doesn't cost more, I mean, I wish the world was like that. But there are trade-offs. And so as a society, we need to be honest with each other about what these trade-offs are.
I think we have time for one last question.
All right, David Harbert from Hubbard Broadcasting. You haven't mentioned consumer debt much in this conversation. Are you tracking it? Presumably, whatever you do will impact that greatly, and it seems to loom as a threat in headlines. So are you tracking it, and what can you share?
We are tracking it. It certainly is. And certainly the area where consumer debt seems to have grown the most that is also concerning is student loan debt. And that seems to be growing with no end in sight. And obviously that crowds out other spending that those workers and those families would like to undertake when they graduate from college, whether it's buying a house or buying a car, et cetera. And this goes back to education is only becoming more important. There has to be a way for us to educate more people at lower cost. It cannot simply be students need to saddle themselves with more and more and more debt. That is not a sustainable economic model. So there needs to be more innovation in how we deliver education to reach more people. We are paying attention to consumer debt overall. I haven't seen data that suggests that it's some big alarming level, that it's back. If you look at, there's sometimes headlines a few months ago that consumer debt reaches a new maximum level, but that wasn't adjusting for per capita. It was, the workforce is growing, the population is growing, et cetera. On a per capita basis, it still seems like consumer debt overall is within manageable levels, but it is absolutely something we pay attention to.
Okay. Anything you'd like to close with, sir?
I just want to say thank you. Thank you for having me. Thanks for asking all the questions and giving me the comments. And thank you for moderating. This was really a great session, so I appreciate it.
Let's thank our speaker.